All right, let's dive right in. Today we're taking a close look at a giant in the Indian market, ICICI Lombard, the country's biggest private general insurance company. We're going to unpack its business, figure out its strengths, and try to answer the big question, is this really a case for stress-free investing? Let's get into it.
But first, I want you to think about a puzzle, one that's at the very heart of the entire insurance business. How on earth can a company make a profit, year after year, even if it's paying out more money in claims than it's collecting from customers? I mean, it sounds completely backward, right? But believe it or not, that's the secret to their whole game.
Well, the answer, the magic ingredient, is something called investment float. It works like this. They collect all our premium payments up front, creating this giant mountain of cash. And here's the kicker. They get to invest that cash for their own profit before they have to pay out any claims. And for ICICI Lombard, we're not talking about a small pile of cash. It's a staggering 53,000 crore rupees.
And this brings us right to our main subject. ICICI Lombard is the top dog, the #1 private general insurer in India with a solid 9% of the market. And they are absolute masters of using this float-based model to turn our premium payments into a powerful profit-making engine.
Okay, so let's see how that translates into real financial strength. We're going to dig into the numbers now and see if ICICI Lombard really is the financial fortress it's made out to be.
Let's start with that massive number again, because it is just so crucial. 53,000 crores in their investment portfolio. You've got to understand it, this isn't just some rainy day fund. This is the core of their earnings, spinning off thousands of crores in income every single year.
And check this out. Here's a number you almost never see for a company of this size. 0. That's right, ICICI Lombard is completely debt-free. In a business world that's obsessed with leverage, this is a huge sign of financial safety and discipline.
Now, this number here, the solvency ratio, might sound a bit technical, but think of it as a safety check. The government requires insurers to have a ratio of at least 1.5. ICICI Lombard is sitting at 2.69. That is a huge safety cushion. It means they have almost double the required capital to handle any and all of their risks.
And this financial strength has fueled some really impressive long-term growth. Just look at the last decade. The revenue has compounded at 19% a year and profits at 16% a year. This isn't just a flash in the pan. This is a solid, decade-long track record of fantastic performance.
So, they're strong financially, but what stops a competitor from just copying their playbook? Well, that brings us to what investors call a moat, their competitive advantage. Let's break down exactly what protects this business and keeps it ahead of the pack.
Their moat is, frankly, incredible. First, they're the market leader. Second, and this is a huge one, their parent is ICICI Bank, which gives them a distribution network that's almost impossible to replicate. You combine that with their massive scale, that giant investment float, and a brand people have trusted for over 20 years. It's a powerful fortress that's really, really hard for anyone else to attack.
And you can see that strength when you put them side by side with their competitors. Just look at the table. Their return on capital is a fantastic 25%. Their underwriting is disciplined. And here's the interesting part. Their valuation, their PE ratio, is much more reasonable than some of the newer high-growth players who aren't nearly as profitable.
Now, it hasn't all been a perfectly smooth ride. To give you the full balanced picture, we have to talk about some of the recent challenges. This is the yes but part of the story that has some investors a little worried.
The big headline was this: a 9% drop in profit in the third quarter compared to the year before. Now, for a company that's been on such a strong growth streak, any dip like this is going to get people's attention. So the question is, what caused it?
Well, it really boils down to three main things. First, their claims went up, especially in motor and health insurance, which pushed their combined ratio a little too high. Second, their health insurance business is growing like crazy, but right now, it's actually losing money on the underwriting side. And finally, there are some outstanding legal and tax issues that are big enough to keep an eye on.
Okay, so we've laid out the good, the financial fortress and the wide moat, and the bad, which are these recent stumbles. That brings us to the most important question of all, valuation. Is the company a good buy right now?
And this is where things get really interesting. If you look at its own history, the stock is currently trading at a noticeable discount. Its PE ratio of around 33.5 is well below its 5-year average of 37. It seems like the market has factored in all those recent concerns, making it cheaper than it's been in a while.
So, pulling this all together, the final verdict from the research note is to accumulate the stock, but with a long-term view.
The analysis points to a fair value of around 2,100 rupees, which offers a potential 25% upside from here. But the key is the time horizon. You'd need to be patient for 3 to 5 years to let the business work through its current challenges.
And that pretty much wraps up our deep dive on ICICI Lombard. Before we go, though, just a couple of final, really important points.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please do me a favor and hit that subscribe button. And don't forget to press the bell icon so you never miss an update.
And finally, I really want to hear from you. Which Indian listed company should I analyze next? Drop the stock name in the comments below, and it might just be the star of our next explainer. Thank you so much for watching, and as always, keep your investing stress-free.